and welcome to the latest edition in our KPMG 10 Minutes on Tax video series. Today we're looking at current employment tax developments and importantly where things are headed in the area in a post-COVID environment. My name is Claire Davey, I'm a tax director in KPMG and today I'm delighted to be joined by two of my colleagues, Duncan, an Associate Director in our People Services Tax Practice, and Senan Kavanagh, a Tax Director in our Tax Transformation and Technology team. Duncan and Senan, you're both very welcome here today. Duncan, I might start with you first. The COVID income support schemes have been a lifeline for many businesses badly hit by the pandemic. Can you give us the latest today on the Employment Wage Subsidy Scheme?
Yeah, thank you, Claire. For employers already availing of EWSS at the end of 2021, the scheme is due to close on the 30th of April on a phased exit basis. Principally, the enhanced wage subsidy rates were reduced for February and further again for March and April, and there's a return to full rates of employer PRSI with effect from March. So for the vast majority of businesses, everything is coming back to normal from a payroll perspective from 1 May. The only exception to that is if there was a business that was directly impacted by the public health restrictions in place in December and January, in which case such businesses are entitled to enhanced rates and an additional month on the scheme. OK, thanks Duncan. Turning now to the taxation of benefits in kind. Are there any recent updates on the operation of benefit in kind on employer-provided vehicles? Yes, during the COVID period, helpfully, Revenue allowed the company car BIK to be based on the business mileage performed in the pre-pandemic month of January 2020. However, recently, Revenue confirmed this measure will only continue into 2022, where there's a public health guidance requirement for all employees to work from home. Obviously, this is not the case currently, so expectation from January 2022 should be that car BIK should once again be based on the actual business mileage being performed. OK, thanks Duncan, that makes sense. And in relation to expenses incurred by employers on behalf of employees, say for example COVID testing and flu vaccines, what's the latest update on this, Duncan? Well, some good news here, Claire. Revenue have confirmed there will be no taxable BIK arising in 2022, and for subsequent years this will be reviewed on an annual basis. You'll recall that Revenue also agreed that a charge to tax will not arise where an employer provides the cost of transport for employees between their home and the workplace due to health and safety concerns. This concession is currently still running until the 30th of June 2022, but Revenue have confirmed that this will be subject to review before this date. Great to get that clarity, Duncan. And as I understand it, there's also been some recent clarifications in relation to what's often known as the small benefits exemption. Can you give us the latest update there, Duncan? Yes, that's right, Claire. When it was deemed that an employee's efforts were exceptional during the pandemic, Revenue waived the requirement that only one tax-free voucher may be issued during 2020 and 2021 on a concessional basis. The cumulative value of multiple vouchers still shouldn't exceed €500 per annum, and the good news is that this concessionary treatment will continue to apply for 2022. That's good news indeed, Duncan. Duncan, focusing your attention now on remote working, given the steep rise in remote working, I understand the government are now looking at legislation which would provide greater rights to employees. Any advice or recommendations at this point, Duncan, in relation to this? Yes, well, aside from the need for employers to stay aware of the inevitable employment law matters that are about to surface, they need to stay aware of revenue tax rules regarding home working. In particular, where employees seek to base themselves outside of Ireland for extended periods, which can be a popular enough request these days, this can carry foreign employment tax risks as well as other issues beyond employment taxes, including personal taxes, social security, corporation tax and even immigration. Advice should therefore definitely be sought before agreeing to employees spending extended time working outside of Ireland. I agree, Duncan. The whole area of cross-border remote working can throw up many challenges for employers, which can extend far beyond employment tax. So I certainly think keeping an up-to-date record of where your globally mobile employees are located at all times is key. OK, changing tact a little now and turning to you, Senan.
The new Code of Practice on Revenue Compliance Interventions is due to take effect from 1 May. Will there be many changes then on how PAY audits and interventions will be conducted now going forward?
Thanks, Claire. Yeah, there's no doubt that future interventions will look a little different. The new Code of Practice refers to Level 1 compliance interventions as being in place to support compliance, while Level 2 and Level 3 interventions are in place to confront non-compliance.
OK, starting with Level 1 compliance, Senan, this appears to be a somewhat new approach, which, as I understand it, will replace revenue aspect queries. Is that right?
Yeah, that's right, Claire. Level 1 interventions will take the form of a reminder in relation to outstanding tax returns, requests from revenue to carry out a self-review, a profile interview on a certain issue or item that has come to revenue's attention, as well as engagement under the cooperative compliance framework, which has been in place now for a number of years.
OK, so essentially we may see revenue asking employers to conduct their own self-review of PAY or other tax matters, but also retain the ability to make an unprompted qualifying disclosure. Is that right, Senan?
Yes, Claire, that's right. There may be a mix of self-review and regular audit activity. This is very much in line with the approach being adopted in other countries and in line with the OECD Tax Administration 3.0 discussion paper on the digital transformation of tax administration. Businesses may be asked to carry out a self-review before being called for a traditional audit.
OK, so turning to revenue audits now, Senan, I understand they're covered in Level 2 and 3 of the new code. Is that right?
Yes, Claire, that's right. Under Level 2, there are two types of intervention: risk reviews and audits. We understand that risk reviews may be an examination of data provided by taxpayers as part of a tax return or through real-time reporting of payroll taxes. A risk review may be a review of a particular area or issue, while an audit would be a review of everything in the period under audit. We expect that the turnaround times for risk reviews will be very tight. The key difference between these types of reviews and what was in Level 1 is that the ability to make an unprompted qualifying disclosure is gone at Level 2.
OK, and presumably then Level 3 interventions relates to where a serious tax or duty evasion has deemed to have arisen.
That's right, yeah.
OK. So in summary, Senan, what you're saying then is the likelihood of revenue requesting employers now to conduct their own self-review, it may potentially be high. And this will be a big change for employers going forward.
Yeah, for sure. While obviously it remains to be seen exactly how it'll all play out, yeah, we do expect there to be a lot of focus on self-reviews going forward.
And finally then, Senan, just before we finish up, I know yourself and the tax technology team have a huge amount of experience helping employers through a revenue audit process. Given the new Code of Practice, do you feel that your work and the team's work might change in any way as a result?
There's no doubt that it will change a little bit, but the focus for us has always been to help clients to better understand their data and to identify the tax risks within that data. The big change is that the need for this type of exercise will now be part of a self-review in many cases in the first instance, and it's positive for clients that they can make an unprompted qualifying disclosure at this point, which would limit the exposure to penalties and interest.
OK, thank you, Duncan and Senan, for your contributions today. That's been really helpful and informative. I think it's clear from our discussion today there's certainly been a renewed focus on employment taxes more generally in 2022. And given the progressive nature of employment taxes and of course the many challenges brought about by COVID, now is an ideal time for employers to consider undertaking that self-review of their PAYE operations to date and to consider any improvements necessary to ensure a high degree of compliance going forward. If you have any questions in relation to any of the matters discussed today, please visit our kpmg.ie webpage for regular updates, or please feel free to contact me, Senan or Duncan, or your usual KPMG contact. Thank you for watching.